All right, let's go ahead and get started. Welcome everyone. Again, my name is Mahesh Odhrani. I am the host today. I am with Strategic Wealth Design, and this is our last webinar for the year, talking about the end of year overview. So welcome, and it is my pleasure to also have our presenter Matt Potter with us as well. And I'll introduce him in a moment after I go through a couple of housekeeping items. As far as attendees go, all the attendees are automatically muted, and if you have either a comment or a question in your portal for GoToWebinar, you will have the ability to. I'm getting a little bit of feedback. Matt, are you hearing that too?
I'm not, actually.
Okay. I'm going to try and power through it. So talking about the GoToWebinar portal, there is a question box and a chat box. As Matt goes through his presentation, or if there's something that I say, if you have a question about, go ahead and put that in the question box. If you have a comment, if you just want to say hello, go ahead and put that in the chat box on the bottom. It's nice to see a lot of familiar names here that are on attendees. I see Jen, Barry. Hello, Barry. I haven't talked to you in a long time. Amy, Alex. So again, thank you for joining. It is a pleasure to have you all. So let me go ahead and introduce Matt. Matt, you still there, right? I haven't lost you.
I'm here.
Perfect. I'm not sure if you want to turn on your camera at this point. I know you turned it off earlier. So
there we go.
All right. Yep, I can see you. Perfect. Great. So we have Matt Potter, CFA, a chartered financial analyst. Is chartered or certified financial analyst?
It's chartered.
Chartered. Okay, perfect. I got that right. So he's a charter holder, member of the CFA Institute and the CFA Society of Philadelphia. Matt has been with SEI since 2013. He has been in the industry for over 25 years, has experience in the financial services industry, and he's played a variety of roles with Invesco, Morgan Stanley, and other familiar names as well. Matt's role today with SEI is working with independent financial advisors like us and helping us with investment case analysis, proposal design, but he leads the team of managers and provides technical expertise to all the relationship managers at SEI. So Matt does a lot of speaking around the economy and financial markets. If you have seen some of our videos that we share with you with our quarterly financial updates, Matt's actually in some of those videos too. So his face may look familiar if you have seen those videos. So outside of SEI, Matt is an avid sports fan, particularly football. Is it college or pro football?
Pro football and college wrestling. So
got it. Okay, pro football, college wrestling, and then some track and field as well. So he enjoys nonfiction books and has 2 children, 3 pets. I did not know 3 pets. All one type, or you've got some cats and dogs and something else.
1 dog and 2 cats, which makes life interesting at times.
Oh, I bet. So, but Matt, welcome, and thank you for doing this for us today. We've got a packed agenda, a lot of great information that Matt's going to cover. Please, again, if you have any questions, put them in the question box. If the time is appropriate, Matt, I'll pause you and say, hey, we have a question. If the time is not appropriate, we'll wait till the end to go through the questions as well. So, but with that said, Matt, take it away.
Great, that sounds good. Thank you so much. Thank you everyone for joining us. We finally have the technology down. You'd think after doing this for 1.5 years, it would be a little more smooth, but every now and then there are bumps in the road. So it's been another interesting year. There's a lot to talk about. I thought rather than sort of go over every single asset class and everything that happened, I talk about a few themes, beginning with equity market volatility. Certainly we've had some people ask, well, we've had a long period of rising markets. What's going to happen next? Should we be moving to cash? What's going to happen on the inflation front? Is it here to stay? Is it going to recede? Will interest rates go up? What's your forward outlook, and how should we be investing? Where are we seeing opportunities? Obviously, nothing's guaranteed, but we can certainly look for areas that we think look attractive. And then I want to talk about a couple topics related specifically to SEI. I don't want to be too much of a commercial, but I think there are some things that we do that are interesting, and so I do want to relay those, and obviously we can take questions along the way or certainly at the end. So with that, let's dive right in. First off, one of the things that, it is not your imagination. Stocks have been on a tear since the lows of March of 2020. The stock market, this is one index, the MSCI USA, but probably comparable to the Russell 1000 or the S&P 500. In blue, basically, US stocks really have led the way for the past year and a half plus. There hasn't been much in the way of downside volatility. They have been pretty consistently going up. You can see a couple of dips along the way. But, we have had a lot of strength. And there's the classic expression about climbing the wall of worry. There has definitely been a lot of things to worry about, COVID-19, the supply chain issues, inflation, things outside the US, but it is, markets have still continued to advance pretty strongly. Now with that, I think it's helpful to take a look at what does normal market volatility look like, and have we had this over the last year and a half? What this shows is two things. So this is for the Standard & Poor's 500 index. The blue bars show the number of times on average per year you will see the market dip 5% or 10% or 15% or 20%. And then the orange bar shows the percent of the time that one will become the next level of severity. So for example, we have a 5% dip in the S&P 500 about 3.5 times per year on average. It is a pretty frequent occurrence. Markets can drop 5% for very little reason, and so this happens quite a bit. However, only about a third of the time, 32%, does a 5% dip become the next worst level, in other words, a moderate correction of 10%. Those happen about once a year, and less than half the time does a 10% correction turn into a severe correction or a bear market. So I think this illustrates a couple of things. One of them being that, normally this is what you get when you sign up for being an equity owner. You will see these kinds of fluctuations over time. It's perfectly normal, and a 5 or 10% drop doesn't necessarily mean that there's anything catastrophically wrong with the economy or with stocks. Typically, you don't see a severe correction or bear market unless you have a recession or some other type of severe shock. So 5 and 10% dips, again, they're pretty common. Now, since the lows of March of 2020, we've only had 2 5% dips. One of them was last year in October, the other one we just had in September, and in each case, markets continued rallying after those events. We have also not had a 10% correction since that point. So you could argue we may be a little bit overdue for some volatility. It wouldn't be surprising if there were a little bit more in the near term, but we don't know. We don't know really what the near term exactly is going to look like. There could be issues around the debt ceiling. There could be all sorts of things that come into pass. But I think, again, it's helpful to keep the perspective that, even if markets do drop a few percent, even if you're hearing negative headlines on cable news shows or what have you, that doesn't mean the end of the world is coming. It doesn't mean that you should, sell all of your stocks and move into cash in order to, to preserve capital, because timing the market is extremely difficult to do. And the problem with timing the market is you need to make two decisions. So you need to decide not only when to sell, but also when to buy back in. And often that second decision, when you buy back in, is more difficult. What these charts show is essentially, if you do not have perfect timing for selling at the peak of a market and or buying back at the trough of a market, then it shows the either market loss or opportunity cost, depending on if you're early or if you're late, that you can have if you're off by even a month or two. This is based on historical data. And you can see that if you don't have perfect timing, if you're a couple of months too early or too late, that may cost you 10% on the front end and 20% on the back end. And again, the decision of when to get back into the market is very difficult. The market rally that we saw following the bear market of 2020, that was a very quick drop and a very quick and strong recovery. And many people, I think, were caught off guard. They may not have anticipated the recovery would be as rapid as it was. And so that would be the kind of event where it'd be very easy to panic, sell at the wrong time, and then have to figure out when to get back in. And the time when you want to get back in, when you want to hit the trough, usually the situation is pretty negative. The market psychology is going to be pretty pessimistic. It's one of the most difficult times to invest. And so most people, even if they can get the sell right, buying back in is more difficult. So again, you may have losses and opportunity costs that result by trying to time the market and being off by even a little bit. So this is not something that we recommend doing. We think you're better off staying the course, understanding what kind of volatility you may have, and structuring your portfolio so that it's in accordance with your risk tolerance and your objectives. Now, another topic relates to inflation, and there are a few different factors that are driving it. We definitely are seeing supply chain issues, which are resulting in shortages of goods. The demand for goods certainly has been quite robust among consumers, but getting things manufactured, getting them across the Pacific, offloaded in the ports of LA and Long Beach, and into trucks and driven to distribution centers or stores has proven to be very problematic. So when you have continued demand but much lower supply, typically that results in higher prices. Now, interestingly, this isn't always a problem for stock owners, because corporations have actually been doing quite well recently. Earnings have been very good, and one of the things that is important is profit margins have been quite strong as well. Now, this has happened because companies have discovered that they do have pricing power. They do have the ability to pass on higher costs. So when they're seeing higher costs for raw materials, for transportation, for labor, they are able to raise prices on many of their goods. Now, that has allowed companies to remain highly profitable, which I think has been a pleasant surprise for corporate profits, but it has also meant higher prices. And I think that has been a bit of a shock to the system, as consumers really haven't been experiencing much of an inflation environment over the last 10 plus years. I think in many instances, corporations, they haven't really had an opportunity to raise prices. Since the bear market of the recession of 2008, 2009, because the recovery was so slow, they really didn't have the flexibility to do it then. And then we had the decline based on COVID. So this may be the first opportunity that many companies have to raise prices. And so the increases may be kind of truing up for over the last 10 years, and therefore they may be not likely to be repeated every year. So the price increases we've been seeing more recently probably are not going to be sustained at these levels. But inflation certainly is an issue. This shows the consumer price index. There's both the broad report issue, which includes all items, and then there's what's called the core CPI, where they strip out increases in food and energy. Energy in particular, I'm sure you've seen it at the gas pump. Oil prices, natural gas prices are much higher than they were a year ago, and so that has certainly contributed to higher levels of inflation. But if you look back again over around the last 10 years, inflation has been relatively tame. And in fact, it hasn't really been in ridiculously high spiking years, as in, say, the 1970s or the early 1980s. Since that point, it has been largely under control. Now, there's been discussion by the members of the Federal Reserve that they see inflation as being transitory, more temporary, and that many of the elements are going to decline. We see some truth in that, but that may be oversimplifying and overstating the case. We do think that some of the input costs likely are going to drop as we go forward, but some are likely to stay a bit more persistent. So we think inflation probably comes down from these levels, but it may settle in at a higher level than what the Fed or what other market participants may expect. And I think that's one of the issues that the market is wrestling with right now.
Hey, Matt, quick question for you. What's
Yes.
the inflation expectation that the Fed has when it comes to the core CPI or the consumer price index for all items?
Yeah, so the Fed actually, they look at another metric, the PCE, which is similar, but trends at kind of lower levels. Their expectation, I think, based on their most recent announcement, has been inflation kind of settling back to around a 2% plus level. We think it actually may settle in at more like a 2.5% to 3% level. So again, that would be bringing inflation down to kind of more normal historical levels, higher than what we've seen in the recent past, but not necessarily persisting at the currently high levels that we see. We would be in agreement with the Fed on that point.
Yeah. And one more point that I'd like to make about inflation. Even though we see this general inflation numbers, inflation can be personal to a business or to a family or to an individual, depending upon the goods and services one is using. So for example, like this week, I have been driving around to several client offices for meetings, and so my inflation and my cost of gas has been through the roof this week. So for me, my inflation is going to be higher than someone else's that doesn't drive as much. So certainly it has to be personalized a little bit more as well, but individuals listening on the call, for them it's also to recognize, okay, what aspects of their life are more inflationary than others.
Yeah, that's absolutely right. Everyone's experience will likely be somewhat different. If you are trying to buy a new car or even a used car, that is obviously challenging.
Yeah.
The shortage of semiconductors, which are important in the construction of autos, has really led to less production, and with fewer cars on lots, dealers have marked them up $5,000 or $10,000 over lists. So that's been an area where we've seen significant price increases. So yeah, you're right. It certainly isn't across the board. You see it in some areas more so than others.
So it's really not good timing to be in the market for a car.
Yeah, sadly, no. Yeah, and we were thinking of getting one for our son, but he's going to have to wait. So he is learning some of the unpleasant lessons about economics firsthand. Now, one thing that is interesting about inflation is that we have been seeing labor costs go up over the last few years, and this is a trend we think is likely to continue. Individuals seem to have more leverage now than they have had in the recent past. You've seen it, for example, with the negotiations with the employees of John Deere. There are a number of businesses that really been having a tough time hiring people. There's in excess of 10 million job openings and less than 8 million unemployed Americans looking for work. So there is a bit of a mismatch there. And it does look like some businesses, especially businesses where there's a lot of contact with customers, restaurants, for example, hotels of that nature, where it is very difficult to hire people. And so many companies have been having to pay higher wages in order to make that happen. Now, again, it will be interesting to see to what extent companies are able to pass on these higher costs in the form of higher prices, but at least there may be a little bit of a balance. If you're paying more for goods and services on the one hand, but your wages have increased on the other hand, there's at least some degree of balance between the two psychologically. And again, it's been a while since we've seen a significant increase in wages, and so just as companies may be raising prices because they can, many employees may be looking for wage increases because now seems to be the time to do it. And this, we think, is probably one of the more stickier aspects of inflation going forward. Now, that raises the question, okay, higher inflation is typically associated with higher interest rates. Interest rate increases are not good for bonds. There is an inverse relationship between the price of a bond and its interest rate. And so as rates go higher, there's a question, well, isn't this going to hurt bonds, and why should I bother owning bonds at all? We wanted to test this assumption and really kind of offer the idea that there's more to it than just price increases. As interest rates rise, active managers can actually go out and buy bonds that have higher yields which can help to offset some of that price decline. So what we did was a hypothetical example where we said, let's look back 20 years. Where were interest rates in 2001? So that's the solid green line from 2001 to present. And then we said, what if over the next 20 years, rates went back up to where they were 20 years ago? That's the dashed line. Obviously, they won't go up in such a smooth fashion. You do need to make some assumptions about what changes are going to be like. But we had said, okay, if rates return to where they were 20 years ago, what will that mean for bonds? Is it going to be a bondholder's worst nightmare? And as you can see, the dark green bars, which are in negative territory, indicate the lower prices of bonds because of rising interest rates. But the light green bars show higher interest or coupon payments from those bonds, and usually over the long term, investors typically get most of their return from bonds by the interest rates, by the interest that it pays, and not necessarily by the principal value fluctuations. And so that can translate into a positive total return, even in a rising interest rate environment. What's really important is, how are interest rates rising? Are they spiking quickly and unexpectedly, or are they rising more smoothly and in a manner that isn't necessarily a surprise? I think right now most people expect to see interest rates going up. You would expect to see that in a growing economy and with more inflationary pressure. So the surprise value of a sharp increase in interest rates may not be in the cards. And again, bonds make up an important part of portfolios. They can help to stabilize the overall returns and reduce volatility. So we wouldn't advocate selling bonds at this point, because you still can make money with bonds even when rates are rising. Now, the other question is, okay, what does inflation do to stocks? Well, it's interesting because stocks generally are seen as a fairly good inflation hedge. But some stocks tend to do better than others during periods of rising inflation. As you can see from this chart, the least expensive stocks, value stocks, tend to do better than more expensive stocks, which are often growth stocks, higher growing, say, technology companies or other types of companies, which are pricey, but the price can be justified by their earnings growth. Well, those kinds of stocks, and they really have led the way for quite a while, we think that there may be a bit of a regime shift going on. There may be a shift from growth into value within the markets. And this is something that I think certainly bears watching, because many of the names in, say, the US stocks, all of the huge mega cap firms that and may or may not love, have done extremely well over the last number of years. Now, whether that's going to continue indefinitely, we don't think that's likely, especially if we do see, again, more rising inflation. So we would look to position more towards value. These are often financial services companies, things like manufacturing, industrial material companies, things of that nature, which again would be a different pattern of performance than what we've seen in the past. What this chart shows is a comparison between growth and value. So it shows two indices, the Russell 1000 Growth Index and the Russell 1000 Value Index. Again, growth stocks being those where the earnings growth is growing faster than the market, and value stocks being those that are less expensive than the market. And when the line is going down, growth is doing better. And when the line's going up, value is doing better. And you can see, and these are 10-year rolling performance spreads, so they don't quite capture the transitions, but you can see we have been in a long period that's been favorable for growth. It has been a major tailwind, helping many of those growth names. We think it is likely that there is some degree of mean reversion. We do think that value is poised to perform well going forward. It has already started a bit of a recovery. And typically when you are coming out of a recession, that's a good environment for value. When interest rates are higher, that often helps financials, and financials typically make up the biggest sector in most indices. So for a number of reasons, we do think that value probably is better positioned going forward, again, which would be a different pattern of performance than what we've seen in the past. And we think it's also important not to just, whoops, did that just,
Yeah, we're just seeing a blank blue screen.
I don't know what happened there. Let's see what is going on. Sorry about that. Let me go to show screen of monitor 2. Oh, you know what? I think that's weird. For some reason, it shut down my presentation. Hang on one second. I will retrieve it and bring it back up again. Yeah, that was odd. It just suddenly decided that it was tired of showing it and wanted to show something else. So let's see.
The joys of technology nowadays, right?
Yes, they never end. So hopefully you're able to see that now.
Yes, we can.
Good. Okay. Yeah, just have to be a little more flexible these days. So where were we? Yes. So again, we do think that the environment is more favorable for value looking forward. And it is interesting to look outside the United States. Something like 40% of the global stock market consists of stocks of companies that are not based within the US. There is a wide variety of international stocks, companies that may be more interesting now than they've been in a while. What this chart shows is valuations. How expensive are US stocks in the blue versus stocks of developed countries in the orange versus stocks of more emerging economies, younger economies that maybe are a little newer and often faster growing in the green. If you look back to 2010, you can see that back then, these were all similarly valued. They all had similar expectations in terms of their price to earnings ratio. But as we've moved forward, and again, as US stocks have done very well, they've gotten more expensive. So on a valuation basis alone, there may be a case to be made for looking outside the US. Many investors tend to focus a lot of their wealth in investments within the US. We call that the home country bias. And that's not necessarily a bad thing. These are markets that you're more familiar with. And there are many great companies within the US. But there certainly may be opportunities outside the US as well. And so I think it is worth looking beyond our borders. Again, depending upon your risk tolerance, I wouldn't recommend emerging market stocks for everyone as they are volatile, but certainly these are faster growing economies. And given where their valuations are, they may be suitable for a more aggressive longer term investor. But we think being diversified, not just limiting yourself to one country or one type of asset class, makes more sense going forward, just so you don't miss out on opportunities that may be outside the US. So what is our overall outlook? Again, we have more of a positive impression of where the economy is going to be going over the next couple of years. We did have a bit of a slowdown in the third quarter. Certainly, the spread of the COVID Delta variant has been problematic. And I talked about some of the supply chain issues that we've seen, just getting goods to customers and also getting people hired. As we see more of that happen, that will redound to the benefit of the economy. And there still is a lot of support for global economies through central banks, not just in the US with the Federal Reserve, but overseas as well. Companies, again, earnings have been strong, profit margins have been strong, and we've seen good earnings on corporations outside the US as well. Now, all of that doesn't mean that stocks are going to go straight up. Again, we may see more volatility in the near term as investors kind of wrestle with what's going on with growth and inflation, as other issues may come to pass. But as long as we don't see a recession in the near term and we don't see evidence of one, any type of decline, we believe, would probably be limited to a 5 or 10% type of drop and likely wouldn't be too long lasting. So we would see that more as a buying opportunity than a reason to panic. There are always things to be concerned with, though. We do want to pay attention to inflation, what's happening there, how much of it could back down a bit and how much of it may be more longer term. And there's the Federal Reserve. They have been providing a lot of stimulus to the economy, and they have been starting to back off some of that stimulus. Now, there are two things the Fed can do. One of them is actually dictating short-term interest rates. They do that directly. And the other is indirectly keeping longer-term interest rates lower by buying bonds in the open market. One thing to do there is, for example, to try to keep yields on the 10-year Treasury lower, because that's often used to set things like mortgages. They have been pulling back from their efforts to do these kinds of purchases. So this is when you hear that they're tapering, that's what that means. They are reducing the amount of buying of bonds that they're doing. They hope to be complete with that maybe by next summer. Now, the question is going to be what happens after that. Do they start raising rates, or do they hold off? Will they show some patience? It's a little too early to tell, and we don't even know who's going to be leading the Federal Reserve. It may wind up continuing to be Jay Powell, or it may be Lael Brainerd. They both probably have similar approaches and philosophies, so there wouldn't necessarily be huge policy differences, but markets might react a bit differently. So we think it is a little bit early to kind of predict where interest rates are going, but certainly the Fed does want to see employment get back to strong levels, and I think they are going to be looking to emphasize that going forward. And then the last point, obviously, we talked about, we do think that some of the companies that have done really well over the last few years, especially technology and other similar companies with high growth, but also that are expensive, those may have the furthest to fall if we do see rates and inflation rise. So again, we would be leaning away from those kinds of companies and towards things such as value stocks, as I talked about earlier. Now, let me get to a couple of topics that are SEI specific. So with the economy, with markets, there's only so much that you can determine. It is an uncertain future. But when it comes to taxes, things are a little bit more definite. You know what tax rates are, at least currently. You know if you have capital gains or losses, and the amounts that they're going to be taxed on. So one of the things that we try to do at SEI is to really reduce the amount of taxes that you need to pay. By doing this, essentially depends on a few things. One of them is our structure. When we have accounts at SEI, the assets are based here at SEI, and so we oversee everything. Even if we have different managers managing different parts of an overall portfolio, we still will coordinate the overall process. And so when purchase and sell decisions are made, we would look to implement them in the most tax efficient way. Here's a very simple example. Let's say you own a stock and it's managed by an outside manager, and you've owned it for 364 days, and the manager decides that now's the time to sell it, that it's done well, it's time to take profits. Well, if you sold it today, you would have a short-term capital gain, which is taxed pretty high like ordinary income. But if you held it for just a couple more days, now it would go to being a long-term gain because you would own it for more than a year, and that would be taxed at a lower rate. We can pause trades, look and see how long the holding period has been, and delay sales so that sales that might have been short-term gains now become long-term gains. There are also techniques that we can use within portfolios where we own a wide variety of stocks, and if some of them decline a little bit, that's okay. We will sell them, take the loss, buy a similar type of position. So we're still invested in the market, but now you have a loss. And accounting losses for tax purposes actually have value because they can offset gains elsewhere within your portfolio and help reduce your overall tax bill. So there are many things that we can do in terms of how we monitor trades, how we oversee managers, all of it within a framework which is designed to try to keep portfolios as efficient as possible. So again, even if you can't control where the economy is going, where markets are going, you can take more control over how much and what types of gains, taxable gains you're realizing, and take steps to try to reduce the amount of unnecessary tax that might be paid. Now, the last point that I want to talk about, this is a little bit more of a story. One of the things, for those of you who aren't familiar with SEI, one of the things that we do is we employ outside money managers. We hire them, we monitor them, we decide which manager is the best manager that focuses in, say, small US companies or high yield bonds or what have you. And we look to hire them, whether they are large name brand firms or whether they're smaller boutique firms. and we monitor them. And so we want to put together a portfolio of the best managers we can find, really from across the globe. Now, as part of that, we get approached by a number of managers who are interested in working with us. And in fact, before I started at SEI, I actually was working for a manager. We managed inexpensive small companies, and we tried to get onto SEI's manager platform. So I'm one of the few people actually working at SEI who has been through the SEI due diligence process from a manager's point of view. It was interesting. I can tell you that the attention that we got and the attention to detail that SEI showed when they were evaluating my former firm was higher than what we saw with a number of other consultants and other people. I won't name names, but there were many people we talked to who are large and well respected within the investment community. And the issues that my former firm had, largely which were centered around the personality of our lead portfolio manager, were things that other people hadn't even raised as a possible concern. Now, how do I know this? I know this because we went through the process. At that point, we were not able to raise the amount of assets that we needed to be sustainable. So we kind of folded up our shop. And then a little while later, I started at SEI. And I got to talk to the analyst who had evaluated us. I had lunch with him, in fact, and he told me many of the things that SEI was looking at. What's interesting is when people look at managers, they often will look at performance. How has this manager done over the last 3, 5, or 10 years? And that certainly can tell you something, but it doesn't tell you everything about a manager. One of the things we look for at SEI is, does this portfolio management team, is the process that they use a sensible one, a repeatable one, and one that makes sense for the types of stocks or bonds that they're looking to invest in? And do they have the right people with the right temperament and the right team structure to manage it? And that was one of the things they were looking for with my former team. They not only asked us a lot of questions and talked to each one of us individually, but they also wanted to see us as we did our new idea presentation meetings. They said, we just want to be a fly on the wall and watch. And so they really tried to see us in action. I think it is good to see managers in their natural habitats, to see how they interact with one another. Because anyone can sort of come forward, give a good presentation for 45 minutes and sound convincing. But if you take a deeper look, if you talk to more people at the firm and you see how they really interact with one another, you can get a better sense of what the corporate culture is like. And again, that really was the area where my former team kind of fell short. And again, many of the things that the SEI analyst had pointed out were things that I knew and that we had tried to kind of work around. But he had said, look, we didn't just talk to you guys. We talked to people who used to work with this person. We talked to some of your competitors. We talked to just people who knew. There is definitely a degree of knowledge that accumulates as you do this over the decades. And that was one of the more interesting things that I heard. So even when I first started at SEI, I had already come in with some conviction about our manager selection process, and that continues to this day. So with that, those are kind of all the prepared points that I have. Happy to take any questions, and I also will move through some of the disclosures so that our good friends in legal and compliance will remain happy. So yeah, any questions or anything that you would like me to address?
Again, if you have any questions, there's a questions box. Please go ahead and put your questions in there. And while we wait for questions, Matt, I do have. You mentioned the Fed as far as raising interest rates and the bond tapering program. So the bond tapering program is expected to end sometime summer of next year. Mm-hmm. Have they had any indication? I thought there was some indication that they're looking at possibly raising rates sometime in 2022 versus their original stance, which was 2023. So are we expecting higher rates in going into 2020, not probably later part of 2022?
Yeah, so it's interesting because one of the things the Fed has, I think, taken great pains to do is to kind of separate the tapering decision, how quickly are they going to be done with the bond purchases, and the interest rate hike decision. They have tried to lay those out as two different decisions. So the minute they finish one doesn't necessarily mean that they're on the clock to get the next one started. I think they are going to be data dependent. They are going to certainly look to see what is inflation doing, and are some of the measures of inflation beginning to back off. But also keep in mind, there may be a new head of the Federal Reserve, of the Federal Open Market Committee. There also may be some new central bank heads. We've seen a number of people who are retiring or retiring early, and so they will need to be replaced. So depending on who's appointed, there may be a different tenor or personality to the Federal Reserve, and they may be a little bit more patient. I don't know that you can necessarily assume that we will see rate hikes as early as next year. We could, depends really on how inflation is proceeding, but it is also possible that the Fed, again, they may want to see employment get back up to the levels that they think are necessary, because that's part of their dual mandate. And so I think, we've seen a period of low inflation for quite a while. They are willing to live with a little bit higher inflation as long as they see it as not being too dramatic and really spiking. So jury's still out on that, I think, and some of it will depend on who's actually leading the Fed and what do the inflation trends look like.
Okay. And talking about the labor shortages, for most clients that we work with at our businesses, they're all feeling the pain of labor shortages. Is there, if we have, and we're hearing about individuals that have left the labor force market, they're probably not going to come back, they're retired, or they just decided to stay at home. What are the possible solutions for the labor shortage? Are we just waiting for individuals to graduate from college? Are there changing of immigration policies, or what are you guys seeing out there?
Yeah, and that's a really good question, and I think you're right. It's probably more of a multi-pronged solution. Certainly, some of the factors, in addition to early retirements, and it is possible that some of the people who retired early might come back into the labor force, but I think you're right. Probably most of them will stay out of it. I think one of the issues has been really school policy and the availability of childcare. I think just uncertainty about consistent childcare, because a lot of daycare centers are very short-staffed. My niece just started working at one about a month ago, and they were thrilled to have her come on board. They're having a tough time finding people, and if you don't have consistent available childcare, that makes it difficult to to really do any job consistently. That I think is one factor, and I think you're right that it may be time to take another look at immigration policy and see sort of what makes sense for matching employer needs with employee skills, because to some degree there's not only the numbers where there's more openings than employees, but also there may be a bit of a mismatch in terms of in one region they may be looking for people with a certain set of skills, and there may not be that many there, and the people who may have those skills may not want to move to that region. So all of them, I think it is sort of a slow correcting process, but some of it is, I think, related to demographics, and so this may be something that will take a little bit of time to work through, but yeah, it does, I think, present a bit of a conundrum, and probably means, again, that for the time being at least, labor has a little more leverage, and likely will be looking for higher wages, at least in the near term.
Got it. And we don't have any other questions from the participants, but I do have one final question. The hot topic over the last really 24 months since the pandemic has been even hotter is crypto. Yes. And we've heard about a fund that was approved recently by the SEC for crypto, and certainly it sounds like there's going to be more coming down the pipeline. In terms of managing portfolios and being a fiduciary on those portfolios, where does crypto fit in all of that? And is that something you guys are in conversations that when the right vehicles are available and the blessings from the regulators, is that something, is SCI looking at incorporating into portfolios?
Not right now, and it may be a little while before we do. One of the issues with crypto, and I should distinguish also between there are the cryptocurrencies themselves, and then there's the whole blockchain system behind the cryptos. There is a lot of value in the blockchain. That is definitely something, there is a lot of there, and many even traditional firms will be able to benefit from the blockchain. But in terms of cryptos themselves, one of the hardest things is to determine what type of instrument is it and how do you value it? Is it a currency? Is it a commodity? Is it a more speculative vehicle? Why are people buying it? Are they using it for purchasing, or are they using it for ransomware? Or are they using it for because they think that someone else is going to buy it for a higher price? And cryptos, they're not associated, they don't pay dividends. They're not associated with an earnings stream like you would see with stocks. They don't necessarily have intrinsic value, so it's hard to know how do you value them. And if you can't value something, you don't know if you're paying too much or too little for it. So we still think this is a more speculative part of the market. We aren't, we certainly are looking at them as the trend. It's an important trend, but there could be more regulation to come. We've already seen that on the part of China. We may see more in other countries. There may be other players who come into the virtual currency space. Even some of the bigger banks, I'm sure, are looking at possible solutions. So depending on, there's still a lot of unknowns. So we still see it as more of a speculative asset class, probably more risky than we would be comfortable with. So at least for now, we do not have any direct investments in any of the cryptocurrencies. And we would need to see more history and more of a way to how you can value them before we would be comfortable owning them.
Got it. So, Matt, thank you so much, and really appreciate you doing this for us and going through SEI's latest update. For all the participants on the call, thank you for attending. And I don't see any more questions here. If you do have any other questions, please do feel free to reach out. There will be a quick survey that you'll receive right after, as soon as we end this meeting. There will be a survey that will pop up, or should pop up, and if not, then you will receive an email within the next hour. So please, we too take your responses seriously. If there's any feedback, please do let us know. With that, have a great rest of your week. Have a great weekend, and have a great holiday. Matt, happy holidays to you and your family as well. Enjoy Thanksgiving, everyone, and gobble, gobble.
Thanks. Take care, everyone.
Take care. Bye-bye.